At some time in Economics 104, I've asked you to go to the bottom of this page right here, where our book is located, and read Appendix A, the retirement account section down at the bottom. It's not really a chapter, it's a very densely written little piece of material that is supposed to advise you about retirement accounts. Now, because it's so dense, I want to give you a little presentation here to suggest to you what you can take away from this, especially for the examination. So this is my video guide to the Econ 104 document entitled Retirement Accounts. Now make sure you read that retirement account document before you look at this video. Here I point out that this is the view from the tee box of a par 3 at Eagle Glen in Southern California. You can see off in the distance is a nice grassy area with a beautiful green. That green is tiny. This shot is a challenge, just like having enough money for a decent retirement. But thinking about this shot is fun when you're standing on the 8th hole tee box. Thinking about retirement will give you a headache, always. And so what I'm trying to do here is reduce the magnitude of that headache. Let's take a look at what I think you need to know. Now, the top of the document looks like this, and I'm not going to ask you to remember all of that. You can look through there and see what the minimums are, and for establishing these kinds of retirement accounts. Of course, the chapter is largely definitional. I tell you what a 401k is and what a simple IRA is and a spousal IRA and how you can use these accounts and under what special conditions you might want to use them. One thing I want you to keep in mind is that once you have a job, the primary advantage of having these kind of accounts is that your employer is going to set it up for you and often pay a portion of the investment contribution, like half of it or even more. And there are tremendous tax advantages to a retirement account. That's one of the reasons why you have them. And some of what I want you to take away from this will involve knowing the distinctions between two of those tax advantages. Now, for the kind of retirement account we're talking about here, you're typically going to invest a given amount every month into a dedicated mutual fund family, where you'll have some choices for the mutual funds you can select. And in the lecture about mutual funds, we discuss about how you might set up criteria for making those choices. I'm going to emphasize here that when you go to work for a company for 5 or 6 years, when you leave that company, you may have a retirement account sitting there with money in mutual funds you don't really like and the like. I'm going to emphasize to you that you have the right to roll those accounts over into IRAs that you control. That is one of the major takeaways I want you to get from that document. Now, here's what I expect you to know for purposes of the exam. I want you to know the primary tax differences between the standard IRA or 401k account and the Roth IRA. There will likely be some kind of question on the examination about these differences. For an IRA or a 401k, any contribution you make from your taxable income in the year of that deduction reduces your taxable income. And multiple examples are given in the document, so I won't go into those here. But if you put $10,000 or so into a 401k account, then your taxable income that year is reduced by $10,000, and that's going to produce for you a sizable tax gain. The Roth IRA doesn't work like that. The Roth IRA does not allow you to deduct the contribution you make to the Roth IRA account, but the gains that you make in that account are never taxed, ever. Even when you withdraw the money, they're not taxed. So the Roth IRA gives you the benefit of getting no tax deduction. That's not a benefit. Gives you no benefit when you make the contribution to the Roth IRA. But over time, the gains you make, including capital gains you make in that account, are never taxable. In the case of the 401k, although you get a reduction in your taxable income in the year in which you make the contribution, withdrawals are taxed as income. And I described that distinction in more detail with multiple examples in the document so you can see it there. I simply want you to know, for the purposes of the exam, these primary differences that I've just listed here. A couple of other important features that I want you to understand as a takeaway. For the transitional employee, as I said a while ago, keep in mind that a rollover IRA allows you to take old investment accounts from previous employers and roll them into an IRA that you control. That could be an IRA of mutual funds. It can be stocks, a combination of mutual funds and stocks. You can buy ETPs. There are very few restrictions on the kind of investments you can make with an IRA. You can put it in a brokerage account. You can put it in a mutual fund account. Your employer of old may resist, but they are required to turn that money over to you. And that means by the time you approach age 55 or 60, you're not going to have 10 or a dozen different retirement accounts out there scattered around. You'll have a retirement account where you're presently employed and one large IRA account that you're controlling. If you become self-employed or you're an entrepreneur, check out the features of the solo 401k very carefully as you decide what kind of account you want to set up. Keep in mind, by the way, if you're self-employed or if you're an entrepreneur, you should make sure you set away retirement money just like someone who works for Intel or for a large corporation. There's tremendous tax savings, and also, of course, you simply want to have a larger retirement account as you approach retirement. So you should perhaps consult with an accountant to decide what kind of account you have, but do some of the research yourself. And also, if you expect to be an heir, then pay attention to the laws as they affect inheritance IRAs. It's the case that if you are given an inheritance IRA, that is, if it's left to you in a bequest as part of an estate settlement, then you are not immediately owed, you do not immediately owe any taxes on that IRA, but you will have to make withdrawals in the future if it is handled properly. One thing I want you to take away from the discussion of the inheritance IRA is you can't wait around on that. Time deadlines are important on those IRAs, so if you're about to inherit some money, pay very close attention to what the rules are at the time you inherit that money. Okay, I think that's sufficient right now for you to have enough guidance on the use of that document, at least for exam purposes. And good luck on the exam when you encounter this.